Hello everyone, welcome to TIOmarkets live trading strategy workshop with me, Janne Muta, Chief Market Analyst for TIOmarkets. And today we're going to talk about momentum really. It is a wide and big subject and I know already that I can't cover everything now. But let's cover as much ground as we have time for. I think this webinar is going to be about half an hour and then we have some time for questions. And obviously, if you have a question, feel free to type it in. I'd rather keep the mics off so that we don't get distractions on this recording. But please feel free to type in your questions and do my best to answer your questions. So, okay, let's dive in. And first of all, I need to remind you that we don't provide any investment advice. All this material is made available for educational and marketing purposes only. You should take a screenshot of this, then read it through on your own time and only apply what you hear and see if you agree with it, if you understand with this, if you agree with this disclaimer and if what I teach here makes sense to you. It needs to agree with your own analysis, and it's really not investment advice. It's really only, and I shouldn't say only because it's more than that. It is something that develops you as a trader. It develops you as an analyst. It helps you to understand what you are doing when you are analyzing the market, when you are trading, or when you are reading somebody else's analysis. And I think to really get most of my analysis that I provide at TIOmarkets.com/analysis and on our YouTube channel, you really have to attend the webinars because this is where you get to see under the hood, so to speak. Okay, so my background's there, in my current role, it's my job to help you guys to trade better, to become better traders. So, I'd love to have your feedback. Please feel free to email us at support@tiomarkets.com and let me know what you think about my teaching and analysis. And if you have developed, if you can see that you are developing as a trader, and if you are struggling and you have questions, feel free also to send the questions to me. support@tiomarkets.com. So, in this workshop, we'll talk a lot about different tools and understanding on momentum. How do you learn to recognize and measure a momentum? What is momentum? Why is it important? And how do you detect changes in momentum? And why is this important? And like often with any teaching, you find that can't absorb everything on one go. You need to have little bits of knowledge and then you understand how to put those little bits together to build something that lasts, something that helps you to grow and become a better trader. Because I keep on saying this, I keep on talking about becoming better traders because it is so important. It is I mean, I've learned over these 20 plus years that that's the only thing that matters. If you have any other focus than becoming better trader today than you were yesterday, I mean, you're gonna fail. If your focus is on I have to make money today, or I have to make back the money that I lost yesterday, it immediately sets your mind into wrong track. It sets your mind to something that's emotional. You start revenge trading. You start taking trades that really do nothing but harm to your account, your P&L. So if your focus is, what do I do? What do I have to do to become better today and every day to become better than I was yesterday? Then your focus is on right things. Then your emotional balance is correct for trading, and then you understand what really counts Because if your focus is wrong, you don't see the right things. But if you are focusing on developing your strategy, developing yourself, becoming a better trader, then you become more analytical, then you become less emotional, then you understand what you have to do in order to make more money. It's basically, obviously, we don't promise any riches or millions, or we don't say that, okay, you do this and you make huge loads of money. But it is, what I can promise is that if you take on heart what I'm saying here, then you develop an attitude of a learner, of a lifetime learner that eventually leads you to become successful in what you do. Because if you devote time on analyzing your mistakes, start to understand that there's valuable information there. Anyway, let's move on. So, what is momentum in FX markets? Upward momentum means that you have new inflows into the market. New money is flowing into the market. No market can go higher in price if there is no new money flowing in. And how it happens is what happens in practical terms is that you will see more and more buy orders coming in at higher and higher levels, so that those buy orders absorb any supply there is. So this is about supply-demand imbalance. The bigger the imbalance is, the more there is momentum. The market is more willing and kind of it moves higher more easily if you see, if there is more demand there than there is supply, because it converts those bears into bulls because they don't see their strategy working, they don't see their approach working. At least this is something that applies to professional traders. I've seen too often that rookie traders or retail traders, they just try to sometimes fight the market. The market is moving to a certain direction. They fight the market. They are selling if the market is going higher because they want to be the heroes that can then tell themselves or somebody else that I was the one selling on the top. I was the one who really picked the top. And this attitude leads to lots of trading mistakes. If you follow the market, if you follow the momentum, you are more likely to be in line with the big financial institutions that are moving the market up and down. The retail traders are really not doing that. It's the big banks that are moving the market up or down. So when there is downward momentum, the opposite is true. You have outflows from the market, you have more supply than demand. And if you try to fight this and keep on buying when the market is trending down, then you either run out of the money now or tomorrow or a day after or very soon at least. It's not the way to trade. If you can find what the big banks are doing and then just riding the waves and riding the trends, then you'll be fine. So it's important to know what is momentum? How do we measure momentum? This is a bit of theoretical background. We're not going to spend too much time on this, but I just want you to have this understanding. So we sometimes talk about rate of change, but it is really, momentum is about rise over run. It's about the angle of a slope. So here's an example. If you have market moving higher, and it moves 2 units over 3 units of time, then now somebody has a microphone on. Can you please switch it off? Okay, I did it for you. Thank you, Stuart. So welcome here anyway. Let's continue here. So if you have the market moving 2 units between these points, this and this, then it takes 4 units of time for the market to move higher by 2 units in price. Or if you have y-axis and x-axis. But let's talk about the price because we are talking about markets. So then the slope is really 2/3, 2/3. So this is rather steady upward trend. How can we detect momentum in price charts? We can have indicators, we can have price action analysis, trend behavior analysis, and this can be broken into several smaller sort of subsections. You have lots of different indicators, you have lots of different ways to do price action analysis, and then trend behavior analysis also. And in this webinar, over the next 20 minutes or so, we are going to cover, I think, one of the approaches. So, momentum analysis can be used to detect if the price is likely to continue higher or lower. That's obvious. But it can be also used to detect if the price is likely to reverse or move sideways. All this information is highly valuable because it tells you how to trade or when not to trade at all. Sitting on your hands is really a trading decision. Staying in cash is trading sometimes. It is, we often think that if you are a trader, you have to be active all the time. Only if you are trading 5-minute, 1-minute charts and you are a scalper, then you might be active all the time. But most of us, we are trading intraday moves or swing trades. We don't have to be active. There are times when we have to be in cash and waiting for the next opportunity. And this information, momentum, understanding the momentum that is prevailing in the market at the time is highly, highly important and valuable to us. So, momentum tools, there are moving averages, oscillators, trend lines, Bollinger Bands even. It might not be that obvious, but once we get there, I'm going to explain to you how to use Bollinger Bands in momentum analysis. And then price formations, trend structure, higher lows, higher highs, lower highs. All these will help you recognize. And I'm going to obviously, there's a lot to talk about these, so let's move on quickly. What I want to start with is moving averages as momentum tools. They help, I mean, if we use moving averages, then we have to pay attention to direction, position of the moving average relative to other moving averages and relative to price, then crossovers of moving averages and crossovers of price and moving averages. Then distance to price and other SMAs. And we can also analyze whether the moving averages are fanning out or squeezing together, provided obviously that you have multiple moving averages that you are using in your analysis. Then there are bounces and penetrations. Sometimes the price comes to a moving average and really bounces higher quickly and easily. And then sometimes you start to see how the price penetrates the moving average, and that is a message on its own. And at this stage, I need to say that obviously there are people who find this very, very simple, but then there are people who find that some of this is new. So let's use what there is available here today. And if you have questions, I'm more than happy to answer. If you feel that it's too simple and basic, please let me know what would you like to see. But I'm not really trying to give you a simple system, like somebody would say, like people often are attracted to websites and videos where somebody gives a set of rules and set of indicators and says, okay, this is the system, trade this. I'm trying to go deeper. I'm trying to give you tools to develop yourself as a trader, and I'm trying to develop your understanding in a wholesome manner and way so that you can, over time, learn to put things together in more sort of innovative way, so that you can be innovative on your own and you don't have to follow somebody else. You don't have to be dependent on somebody else. Okay, let's go and look at examples with charts. But first of all, I'm going to take a quick screenshot of this so that I remember what I need to go. It on another screen there. And now to the examples with charts. Okay, first of all, let's talk about direction, and as always, your questions and comments are welcome. I have taken, I have found it useful to use 2-hour charts, and that's basically because they contain a lot of the same information that 4-hour charts do, but they give you a little bit more detailed picture of what's happening with the price. But now I really want to focus on the 50-period moving average first. I'm going to take the 100 and 200 off. And if you are, I think I was going to say that if you are a new trader, I think you find this useful. But also, I find that simple things work the best. And I'm not really convinced that there are things that are only applicable or relevant to new traders, and then that's something that is only relevant to more experienced traders. What I'm trying to say is that if you are an experienced trader, try not to ignore something that looks very simple and something, because if we think that something is only for the newbies and new guys, then we kind of close our mind and don't see the possibilities there are. It's always, I like this saying that mind is useful. Mind is like a parachute. It's only useful when it's open. So let's dive in. So this is a very simple, very, very simple idea, but it works. It obviously needs more analysis and more kind of factors, strategy, components is the word I was looking for, in order to create a strategy. But let's start with the basics. How do we measure momentum with a 50-period moving average? These periods when the price is above the average and the average is moving higher, you can see that there is a high likelihood of price moving higher. There'll be periods when there are surprises, but then that's what the markets are like. You just can't get away from it. There is no strategy that is perfect, something that works all the time. It just doesn't exist. But you can see that there are periods when price really moves, when you have the moving average pointing higher. If you take point A and then you take point B and the difference is positive, you obviously have momentum. And you can see that the price really moves higher at the same time. It doesn't matter where you do the same analysis. If the price is moving below the moving average and the moving average is pointing lower, it's more likely that the price moves down. Now the obvious question is that what do we do when the price, let me rephrase this. What is this analysis style relevant because there are periods when the price moves below the moving average and moves lower, but then there are periods when price is actually moving higher while the moving average is moving lower. Yes, that's true, and that happens. But if you get into the trades fairly quickly after the price has started to move below and started to break supports, and don't wait for a long period of time. Obviously, this needs to be defined. What's a long period of time? But the longer you wait, the more likely it is that the price eventually sort of returns above the moving average. It's just the nature of the price. You have directional moves, and then you have something that is called mean reversion. So all the markets eventually revert to the mean. And the further we wait, the more likely it is that a mean back to the sort of average price. If you take this high and this low here, then the average is somewhere here. And you can see how the price returns to that average. Here, then it moves up, returns to the average again, and then starts to trend higher. So those obviously are challenging periods, and these are periods when a strategy like this is likely to lose some money, but then that's going to happen with all the strategies. No strategy is profitable all the time. And what's important here is that these periods when the price has a directional move, they are rather long compared to these periods when price moves against the moving average. Then again here, from this point on, the moving average is moving higher and the price keeps on moving higher. And then, like before, like here, we have market moving long enough and then it starts to move against the moving average. So this is what you need the stops for. Wherever you are entering in, and that's a matter of another discussion, wherever you are entering into your trades, you need to have stops to make sure that your losing trades are way smaller than your winning trades. But as you can see already from these two examples, the periods during which the market moves against the moving average, they are rather small. And obviously, I would encourage you to go and study this in different time frames. In different markets, different time frames. I'm using 2-hour chart here because it is, for the reasons I explained earlier, I find it useful. And then you obviously have these periods when market really moves nicely and takes off. So that's one of the ways. In the chat window, can you please tell me what you think about this? Does it make sense to you? Do you find this idea useful? Do you find this idea difficult to use? And if you do, please let me know why. While you do that, I'm going to move on. So now we have covered the direction and the position of the price relative to the moving average. Let's go to crossovers. And I'm going to use, I'm going to take 200 and 100 period moving averages into the picture here. Get rid of these arrows for a moment. Now, I think most of us are familiar with the idea that you should be a buyer if a short-term period, short period or short-term moving average moves above a longer-term moving average. Okay, Stuart is saying that it seems like a simple idea. I will definitely research this more. Excellent. I love to hear that, Stuart. I love to hear that you are actually getting some benefit and added value from this. And when you start studying this, make notes, take screenshots, and try to find areas where this idea doesn't work. That helps you to understand what the challenges of any strategy is likely to be, of any strategy that is based on this idea. Because obviously you want to know the strengths and weaknesses of any strategy that you are going to use. So, crossovers, if you buy right after the crossover, can you see what happens? The market has been moving higher quite a bit, and then here's the crossover, and what happens is the price doesn't have that much to run anymore, and it retraces quite a bit, and obviously you don't want to have a stop that is this wide. So I don't like the idea of buying after the crossover. There needs to be some other elements into the strategy, but the crossover can tell you something. It's, first of all, you have the price crossing over and staying above. Then you have the moving average crossing over. And this changes the picture. That's the main message for me. Looking at this, what happens here is definitely different to what happens here. Here you have a different psychology in the market compared to here. So the market, something changes here. You have the 50 period moving above, then you have the 100 period moving above the 200 and staying above. The market starts to create higher lows and move higher. So it's valuable information, but it is, in my mind, wrong to use as just a entry tool. It is a sort of bullish condition tool for me rather than entry tool. And for entries, we need something else. Okay, Luke is saying, I used to use this to scalp the opening of the US stock market. It definitely works, but I think that's where human psychology comes in. We're always seeking the magic bullet to solve all our problems. Yeah, that is so true. That is so true. I find it in my own trading and thinking and analysis that I would love to have this one single idea or one single factor or component to be the basis of my trading system. I just would find it so easy. And it just doesn't work like that, does it? I mean, you guys obviously have been trading and analyzing the markets for quite some time. So you know that you need a combination of things. You need to combine several aspects, several technical aspects, and maybe even fundamental aspects in order to have a trading edge. Yeah. So, very good point. Thank you, Luke. So, crossovers. If the price crosses over, it's obviously bullish. But if the price has been running quite a bit higher and then crosses below, and then that's bearish. And you can use these 3 moving averages, for instance, as a kind of filter of what's happening with the momentum. So if the price crosses below, and then you have quite a few bars staying below this moving average, then the risk of market being weaker is obviously greater. This is telling you that, again, psychology here is different to here. Then somebody might say, okay, what about this? Price crossed below, and then price crossed below here too, and still we had this rally higher. So why doesn't this happen again here? I think the reason is the big rally. When the big buyers came into this market somewhere down here, and then they made their money, then they obviously at some stage people start to take money off the table and the price starts to lose momentum. So if market is kind of building up strength here, it sort of crisscrosses around the 50 and 100 period moving averages. But that's different to when you have market moving up here after a big move higher, and then you start seeing moves below the moving average, and those moves tend to stay below the moving average. And then price starts to move sideways. What happens after a little while, we have more and more consolidation. Price doesn't roll over. It starts to make higher lows, and price starts to stay above the moving averages again. And there we go again, higher. So this point here was a sign of it was signaling the loss of momentum. It was signaling potential move lower in this market. And quite a few people thought so. They obviously, these people here were trying to sell this market, thinking that it's now below this support, now it needs to move lower. But the fact that the market started to move around this 100 period moving average, it didn't stay below it. It moved higher. We have, direction here. We talked about direction earlier. We have talked about position, price staying above the moving average. And here it works again. The price starts to move higher. So we have to read momentum all the time using these different aspects of momentum analysis. Okay. Let's use this same data here again for something else. Distance to price. Distance to price. Basically, let's use this. Okay. So here we have a trend line, and here we have a sort of a short-term moving average. And as you can see, when, oops, sorry, wrong tool there. When the move is only starting, and obviously this is kind of so obvious because we see everything with the benefit of hindsight, but in normal life, this is what you would see. You would see the price moving higher from the moving average. And then after a little while, you see that the price is moving again higher and the distance between the moving average grows. I'm showing this to you not as much as I'm not trying to convey a big revelation here to you. I'm trying to give you another tool for your toolkit. You can use those when you create maybe automated trading strategies or just use your own discretion in trading. But you can see how the price moves away from the moving average. All this time, the move is accelerating, but there has to come a point when the price has moved too far from the moving average. So this can be your early warning sign that something is not quite right anymore in terms of bullishness. Here the market rallies and rallies and here still rallies, but then obviously something has changed here. So maybe this is your exit signal. Maybe you started buying here as the distance kept on growing. Maybe you added to your trade, but then once the price isn't moving, the distance isn't increasing anymore, maybe that's the time to get out of this long trade and wait for a short signal or other long signals depending on your strategy. And basically you can use the same idea for the moving averages in certain settings, but obviously when you have a kind of longer term moving averages like 50, 100 and 200 period moving averages, that might not be such a great idea. But here again, let's do it on the other side. It makes more sense, and you start to see something else there maybe also. So here we have a long distance from the moving average, and then shorter distance from the moving average, and then price eventually moves above the moving average. So that's enough for this. And I want to take you to another chart I have here, and this is basically again green, red, and blue, but in different times. Sorry, different periods, different look-back periods. I have 10, 20, and 50 period here, and all that. If you are using moving averages in your analysis like this, obviously all that you are doing when you change parameters, change the look-back periods, is that you are either creating a system that gives the price more space to move, which can be beneficial if you are designing a longer-term strategy, or if you're using these shorter look-back periods, you are creating a more sensitive system, a system that takes you out from a long position quicker than a system where you have longer period moving averages. Obviously, these are not reacting to price movements as much as these. So, I was talking about fanning out and bounces versus penetrations. Here you can see how the prices, or the moving averages rather, when they fan out, like here, 1, 2, 3, their distance grows bigger, then you have momentum in the market. Here they squeezed together the two shorter period moving averages, and obviously the 50 period was closer as well. But then when they start to fan out, you have more momentum, and then they start to squeeze in, you have less momentum. So there's another tool for you on how you can analyze momentum in the market. And then the price, when there is really not much happening in terms of momentum anymore, all the moving averages are really close together. And that can be either a sign of market moving sideways or getting ready to reverse. And bounces versus penetrations, that's the last thing I think we have time for today. As long as you can see the market coming to a moving average and really quickly taking off again, that's a good sign of upside momentum in the market. And when you see the same happening here, and the price quite quickly returns, then this is obviously showing you no more quick bounce, no more momentum in the market. And then we go forward and we can see how the price starts to bounce from the proximity of the moving average again, and that leads to a rally. So again, I would like to ask you, I think I've covered as much ground as I think it makes sense to cover today. We can go into other types of analysis, price patterns and oscillators and trend later in other webinars. But if you have questions, let me know. Now's the time to ask your questions, and also if you have any comments, I would love to hear them. Thank you, Stuart, and thank you, Luke, very much for those comments. I really appreciate, because my job is kind of lonely as long as I'm just writing analysis and making videos. But when I get to interact with you guys, getting your comments and feedback and questions, I really do enjoy that. So I'm kind of selfish here, but at the same time, I try to help you out by giving you an opportunity to ask. So please fire ahead. Thank you, Helen. Helen's saying very practical webinar. Thank you for sharing your expertise. You're most welcome, Helen. Paula is saying, if we are watching the analysis in hindsight, how do we predict while the market is moving? Yes, that is difficult. That is obviously much more difficult. And then you have to remember a couple of things. One of the most important things is to remember that we are always dealing with probabilities. And in order to get the probabilities on our side, we need to study the past price action so that we understand what our edge is. How do we, using, for instance, this type of analysis, how do we create edge for ourselves? And the edge, obviously, is defined as, let me think. We often talk about positive expectancy. And positive expectancy, sorry, Paula, this is a kind of long-winded way to answer your question, but I need to go back a little bit and then really answer your question. Positive expectancy means that I'm going to use a simple example here. If you buy a market where you have moving average, the longest term moving average, trending higher, and the moving averages are fanning out. And then you do it again here. And you have done it before here. Sorry, meant to copy both of those. Then a strategy like this is likely to have some really good runs. And again, there are good long trades and they make money. Then this strategy is likely to lose money every now and then. And positive expectancy comes if the winning trades are producing more money than the losing trades are losing money. So that's your edge. But you also have to be able to define your edge in terms of what do I do when I see A, B, C, D happening in the market. And that confidence to do the analysis when the market is moving comes from understanding enough of how the price is likely to move and having enough history in analyzing the market. So you need to look at the price action here, the past price action, and decide, okay, if I see A, B, C, D, then I'm going to take a long trade. If I see something else, I exit the long trade. And then you go back in price history, you make notes, or if you have skills, programming skills, you can program your rules or ask somebody to program them for you. But if you don't, then you just go back and study the price charts. And once you know that your strategy seems to work most of the time, then you can go back and do the live prices and decide that, okay, I'm going to now create this strategy. First on demo, then on with small amount of money, and then once you see it working, trade it with bigger amount of money. Obviously, you want to make sure that your strategy works before you are going to lose or risk money, because every strategy is losing money every now and then. And it's only the question of quality of the strategy, how good your strategy is. If it's really good, then it's only going to lose money by 20% of the time, or 10% of the time, or even 30% of the time, and it's still a good strategy. But you have to be able to endure those losing periods, because or by only allowing the market to take money away from you every now and then, then only you can participate really. If you don't participate, you don't lose money ever, but then you don't win trades ever. It's as simple as that. You just have to know that if I'm buying, my probability of losing is smaller than my probability of winning. And then it's with this on the background, or in the background, with this understanding of analysis and price action, just have to take a dive in. When you see something like this happening, obviously these are only sort of moving average analysis oriented ways of looking at the price action. You can obviously have other types of analysis, market structure, for instance. You can look at higher lows here. You can look at a breakout from say, you have a breakout there, you have a higher lows there, then the market moves here, moving averages start to fan out, and you enter the trade. But even then, you never know for sure if the market is going to go higher. Is it going to go higher from here? If this is the hard right edge here, we don't know if market is going to go higher. But at the same time, we too often look for something that is certain. It's the human tendency to seek for safety. So, for instance, if you go across the street and there are cars going by every now and then, you try to make your best observations to the left and right to make sure that there's no cars coming, and then you go over the street. So you have a high probability of getting to the other side unharmed if you are doing your analysis properly, if you are checking that no cars are coming to you. But even then, you don't know if you're going to get to the other side. You don't know. You only have the probabilities. There might be something that you didn't take into account. There might have been a car that was coming too fast. You were thinking it's coming much slower. Or there are many other things in life that we take for granted that they are safe to do. They really are safe only because of probabilities. If you travel in an airplane, you don't have any guarantee that you are going to get home unharmed or to the travel destination. You always have to rely on probabilities of pilot being an expert, pilot knowing what he does, aerodynamics of the plane, that it's been serviced and everything. It's all about probabilities. And that's the way it is with trading. You have to make sure the probabilities are on your side most of the time, and then you have to accept there are times when the market goes against your analysis, and that's why you have a stop in place. Never trade without stops. There are people who think that if I keep on selling this market, price is going higher and higher and higher. If I just keep on selling this, then eventually it will turn, and then I make a small profit. But this strategy is going to ruin you if you start it here, unless you have very, 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 very deep pockets. The market is going to go up and up and up. Some people do that, and it's silly. So keep on trading with the probabilities on your side, and always a stop in place, so that you know quickly if you're wrong, and you always have most of your account untouched for the next opportunity. Right, okay. I promised you this is going to take only 30 minutes to 40 minutes or so, but I have to apologize. This is the way I am. I love to talk about this stuff, and I love to help you guys. So it's once again one of those webinars where it took a lot of time to get through. And there's always more to talk about. So maybe it's time to call it a day. Thank you for your questions. Thank you, Paula. It was really good question there. And like I said, support@TIOmarkets is the email address if you want to give me feedback or ask more questions. And if you have a topic that you'd like me to cover in some of the future webinars, please let me know. And if you guys want to make a big favor to me, go to our YouTube channel, TIOmarkets YouTube channel. Subscribe to it and share the URL with your friends. Share the video URLs with your friends in social media. And I'm sure your friends will appreciate the fact that you are sharing good, solid analysis to them. Excellent. Thank you in advance for this, and thank you so much for your time. I look forward to seeing you in future webinars. So, as usual, I wish that you trade safe, trade with stops, don't overtrade, and see you in the next webinar. Thank you.